Oh, there are so many yummy vegetarian options out there. You could try like lentil soup, veggie burgers, tofu stir fry. The possibilities are endless.
Hello and welcome. As we head toward the end of the year, our minds naturally turn to our finances and, of course, our taxes. But how can we be truly strategic about it all? What are the key deadlines, the rules, the opportunities we absolutely need to be aware of? Well, today we're going to unpack some really essential year-end tax planning strategies specifically for Canadians to give you the confidence to navigate the system. So let's dive right in.
Here's our game plan for today. We're going to break this down into 5 key areas. First up, we'll cover the absolute basics of filing. Then, we'll talk about getting the most out of your tax-free savings account, your TFSA. From there, we'll get into the slightly more complex world of asset transfers. After that, we'll explore a powerful strategy called tax loss harvesting. And finally, we'll clear up any confusion around those critical RRSP contribution deadlines.
All right, let's kick things off with Section 1, Tax Filing Fundamentals. You can think of this as the foundation, right? It's the universal starting point for every single taxpayer in Canada, no matter what your financial picture looks like.
So, this is a question I get all the time. Look, I didn't actually earn any income last year. Do I really need to go through the hassle of filing a tax return? And, it's a perfectly logical question, but the answer often catches people by surprise.
The short answer is a resounding yes. Even if you had zero income, you should still file your taxes. Now, why is that? Well, because filing is literally the only key that unlocks a whole range of government credits and potential refunds that you might be eligible for. The bottom line is, you'll never know if the government owes you money unless you file that return.
Okay, so let's look at the 2 very different outcomes here. On the left, if you don't owe any tax and you decide to skip filing, there's no direct financial penalty. The real cost, though, is an opportunity cost. It's all those benefits you're leaving on the table. But take a look at the right side. It's a completely different story if you do owe tax. In that case, the Canada Revenue Agency will hit you with a late filing penalty. And trust me, it can add up faster than you think.
And that penalty is not insignificant. It's 1% of whatever you owe. But here's the kicker. It gets applied each and every month that your return is late. So the key takeaway here is really simple. Whether you owe the government money or you're pretty sure they owe you, filing on time is always the smart move.
Let's move on to our second section. Now we're going to talk about the tax-free savings account, or TFSA. This is truly a cornerstone of tax-sheltered investing for Canadians, a real powerhouse tool.
So, a question that comes up a lot is all about timing. People often ask, when exactly does my new TFSA contribution room become available? When can I start contributing for the new year?
The mechanics here are actually quite straightforward. Your new contribution room gets added automatically on January 1st, every single year. And remember, you're not just limited to one TFSA account. You can have several at different banks or brokerages. But, and this is absolutely critical, the grand total you contribute across all of your accounts combined can't go over your personal limit. If you overcontribute, there are penalties. All right, let's get into something a little more advanced now in Section 3, transfers and their tax implications. We're talking specifically about the process of moving existing investments, like stocks, from a regular taxable account into a tax-sheltered one like your TFSA. This leads to a really practical question that a lot of investors run into. I don't really have any spare cash to put into my TFSA right now, but I do own some stocks in a different account. Can I just move those stocks over directly? And the answer is yes, you absolutely can. This is what's known as an in-kind transfer. Here's a quick breakdown of how it works. You've got your asset, let's say it's some stock, in a normal taxable investment account. You tell your brokerage you want to move it to your TFSA. Now, step 3 is the crucial part. That transfer happens at the stock's current fair market value, not the price you originally paid. And because of that, this action triggers a taxable event known as a deemed disposition. So what on earth is a deemed disposition? Well, in the eyes of the CRA, even though no money actually changed hands, that transfer is treated as if you sold the asset in your taxable account for cash and then immediately used that cash to buy it back inside your TFSA. They deem a sale to have happened. And the whole point of this is to figure out if you made a profit, a capital gain, that needs to be taxed. Let's put some real numbers to this to make it crystal clear. Imagine years ago you bought a stock for $1,000. It's done really well, and today it's worth $5,000. When you transfer that stock into your TFSA, the CRA deems that you sold it for $5,000.
That means you've just realized a $4,000 capital gain, and you will owe tax on that gain for the year you did the transfer. Now, what if the shoe is on the other foot and you're transferring an investment that's actually lost value? Well, this is where things get a bit tricky. The government has something called the superficial loss rule. Basically, it says that if you sell something at a loss, but then you or someone related to you buys that exact same thing back within a 30-day window, the CRA will deny your claim for that capital loss. They see it as you not really getting rid of the investment, so you don't get the tax benefit.
And that rule actually leads us perfectly into our fourth section, the tax loss harvesting strategy. This is a very proactive technique for managing your tax bill, but, and I have to stress this, it only applies within your taxable, non-registered investment accounts. So what is tax loss harvesting? It's pretty much what it sounds like. It is the strategic, intentional selling of investments that are currently trading at a loss. The whole point of doing this is to realize that capital loss so you can then use it to cancel out or offset the capital gains you've made on your winning investments. The end result? A lower overall tax bill. But, and this is a big but, there are some really important guidelines you have to follow here. First, again, this only works in your taxable accounts, never in a TFSA or an RRSP. It's most effective in years where you have some big capital gains you need to deal with. But here's the most important point of all. This should be an investment decision first and a tax decision second. You should only sell an asset if it truly no longer fits your long-term financial plan. Selling a great long-term holding just to get a small tax break this year is often a losing game.
Now, the great thing about capital losses, one of the few great things in tax, I suppose, is how flexible they are. If your losses for the year are bigger than your gains, you don't lose that benefit. You can actually carry those losses back to offset gains from the past 3 years, which might even get you a tax refund. Or you can carry them forward into the future, indefinitely, to use against any capital gains you might have down the road. All right, we're on to our final section, number 5. And this one is all about your RSSP contribution deadlines, specifically focusing on that often confusing first 60-day rule.
The RRSP deadline is, well, it's a bit quirky. For any given tax year, let's use 2023 as our example, you can of course contribute all year long, right up to December 31st. But the government gives you this special extension period. Any contribution you make in the first 60 days of the next year, so in early 2024, can be applied to either your 2023 tax return or your 2024 return. You get to choose. But once that 60-day window slams shut, any more contributions can only be used for the current year, 2024.
Okay, so here's a classic strategy scenario that often comes up, especially with year-end bonuses. Let's say you get a bonus in February of 2024. That money is taxed as 2024 income. But because it landed in that first 60-day window, you could contribute it to your RRSP and use that big deduction to lower your taxes for the previous year, for 2023. The risk here is creating what's called a tax mismatch. You get a nice tax break for 2023, but now you have this big chunk of bonus income in 2024 with no deduction to offset it. So you have to think carefully about which year that deduction will give you the most bang for your buck. So we've covered a lot of ground today. We've talked about the fundamentals of why you need to file, the incredible power of the TFSA, the tricky details of in-kind transfers, the strategy behind tax loss harvesting, and the unique timing of RRSP contributions. This all brings us to the final and most important question, which is for you. Now that you understand these rules, which of these actions is going to have the biggest, most positive impact on your own financial plan this year?